Hi, welcome to my channel, Second PUC Accountancy. Learn, understand, and excel. Today, we are going to see another sum under retirement of a partner with a new adjustment. So, this is our second sum where we are going to see a different adjustment under the retirement of a partner. So, here, Anita, Kavita, and Sunita are partners sharing profits in the ratio of 5:3:2. Anita retired from the firm due to her illness. On that date of retirement, the balance sheet of the firm stood as follows. This is the balance sheet given to us. Now, on the liability side, sundry creditors, bills payable, provision for legal damages are given. Now, these are the entries which will also appear in the new balance sheet. So, sundry creditors 15,000 will go to the new balance sheet. Bills payable 12,000 will go to the new balance sheet. Provision for legal damages are the old damages, so which will also appear in the new balance sheet. If any adjustment is there, it will be made with this. Next, you have general reserve. This will go to the partners capital account and it will be distributed to all the partners in their old profit sharing ratio. Next we have is the capitals. The capitals of Anita 50,000, Kavita 30,000, Sunita 20,000 will be recorded as the opening balance in the partners capital account. Now on the asset side we have bank 8,500, debtors 6,000 less PDD 500, which will be 5,500, stock 9,000, furniture 40,000, premises 80,000 will also go to the new balance sheet. If any adjustments are there, will be made accordingly in the new balance sheet. Now, the additional information is the adjustments which is given to us. Now, in this adjustment, first one we have premises that is to be appreciated by 20%, then stock is decreased by 10%, and provision for doubtful debts is to be made at 10% on debtors. Third, you have furniture to be brought up, that is, you have to increase the furniture up to rupees 45,000. Next, we have a treatment for goodwill. Goodwill of the firm to be valued at 40,000 rupees and it should be treated as per AS 26. The last adjustment says that how we are going to settle the retiring partner. So it says rupees 35,000 from Anita's capital account should be first transferred to her loan account and the balance to be paid through bank. If it is required or if it is necessary, overdraft may be taken or obtained from the bank. So with this, we are going to prepare the revaluation account, partners capital account, and the balance sheet of the firm after Anita's retirement. So now we are going to see how to treat the adjustments according to the question given here. So first, let's see what are the information given to us as per the question. In the question, they have given us the old partners ratio, that is Anita, Kavita, and Sunita, that is 5:3:2, which can also be written as 5/10, 3/10, and 2/10. Next, Anita is retiring. That's the first partner. So Anita's share as per the old ratio is 5/10. And here we have to find out the gain ratio to treat the goodwill. As there is no other information given to us, the old ratio or the ratio of the continuing partners itself will be the gain ratio. That is, gain ratio between Kavita and Sunita will be 3:2. That can be written as 3/5 and 2/5. So this is the information given to us. Now with this, we are going to proceed to see the next important treatment with regard to the goodwill. We know that the goodwill has to be valued at 40,000. And how are we going to treat this goodwill as per AS 26, which we have already seen in our previous video, how to calculate the goodwill at the time of retirement of a partner. So just reminding once again, just we'll see once again how to treat the goodwill in the case of retirement of a partner. So we know that the total goodwill of the firm given here is rupees 40,000. So the goodwill of the firm is valued at 40,000. Now here only Anita is retiring. So we need to take only Anita's share of goodwill, that is rupees 40,000 into 5 by 10. That is Anita's share, which will be 20,000 rupees. So this is the goodwill of Anita. Since Anita is retiring, her share of goodwill will be borne by Kavita and Sunita. So Anita's share of goodwill will be 20,000. That should be shared by Kavita and Sunita in the gain ratio 3 is to 2. So here the share of goodwill borne by Kavita will be 20,000 into 3 by 5. That is the gain ratio of Kavita, which will be 12,000, and the share of goodwill borne by Sunita will be 20,000 into 2 by 5, that is 8,000. So which we will be recording it in the partner's capital account. So how to record it also we have seen in the previous video. Now when we prepare the partner's capital account again, we will see how to record this goodwill, that is Anita's goodwill, which has to be borne by Kavita and Sunita. Next we will see the adjustments that has to be recorded in the revaluation account. Okay, so as per the adjustments given here, the first adjustment says that premises have been appreciated by 20%. So asset is being appreciated. So premises to be appreciated by 20%. So the premises given in the book value or in the balance sheet is 80,000 into 20 by 100, that is 16,000 rupees. That is the appreciation of the premises. So since the asset is appreciated, the treatment for this will be first we have to record it on the credit side of revaluation account, and secondly in the balance sheet we have to add it to the premises on the asset side. That is 16,000 rupees appreciation should be added to the premises 80,000 in the balance sheet. The second adjustment says that stock is decreased by 10%. So stock is an asset. When asset is decreased, it is a decrease in the asset. So therefore here depreciation on stock is at 10%. So we have to calculate depreciation on stock, which is given in the balance sheet is 9,000. So 9,000 into 10 by 100, which will be 900 rupees. That is the depreciation of stock. This is decrease in the value of the asset. So how to treat it in the revaluation account? It will come on the debit side 900 rupees, and in the balance sheet we will deduct it from the stock on the asset side. Now the next adjustment given in the same section, that is provision for the bad doubtful debt. The provision for doubtful debts is to be made at 10% on debtors. So in this case, how to calculate it? We already have bad debts which is given in the balance sheet. That is 500 rupees. This is treated as the old PDD. So here, so PDD is maintained at 10%. That is on the debtors 6,000. Debtors we have original debtors, that is 6,000. On this we first have to find out 10%, which will be 600 rupees. So this is treated as the new PDD. So we are going to find out the increase or decrease of this PDD, which has to be recorded in the revaluation account. So the PDD which is given as per the adjustment what we had calculated is rupees 600. That is a new PDD. That will be called as new PDD. So this new PDD should be compared with the existing PDD. So deduct the existing PDD which is given in the balance sheet, that is 500. That is treated as the old PDD. So when we compare these two, we can make out that the old PDD is lesser and the new PDD is more. So this means that it is the increase in the PDD, which is a loss for the firm, that is rupees 100. So this should be recorded on the revaluation account debit side. And that is the treatment here, which will be recorded on the debit side of revaluation account and in the balance sheet. Since the new PDD is increased to 600, we will deduct from the debtors rupees 600 on the asset side of the balance sheet. Now, the next adjustment says that furniture to be brought up to 45,000. Furniture is brought up to 45,000. So, furniture is to be increased. It has been increased to 45,000. So, the adjustment value is 45,000. That is a new value. And we need to deduct the value which is given in the balance sheet. That is the book value less book value of the furniture is 40,000. So here the difference amount states that the furniture has increased by rupees 5,000. So this is a increase in the asset, income for the firm. So what is the treatment in this case? The first treatment, we have to make it in the revaluation account on the credit side, 5,000. That is the increase in the value of the asset. And secondly, in the balance sheet, we are going to write the new value directly because earlier it was furniture 40,000, but now as per the adjustment, it says that the value of the furniture is 45,000. So directly 45,000, the revalued amount of furniture will be recorded on the asset side of the balance sheet. So that is the adjustment given here. So with these adjustments, we are going to now prepare the revaluation account. So now we are going to prepare the revaluation account with the given adjustment. So the first adjustment given was the premises. The premises have been increased. So we are going to write it on the credit side of the revaluation account as by premises, that is 80,000 into 20 by 100, which will be 16,000. That is the premises that is increased, 16,000. Next we have is the stock. Stock is being decreased. So it is the decrease in the value of asset. So write it on the debit side of the revaluation account. That is 9,000 into 10 by 100, which will be 900 on the debit side. Now, along with the stock decrease, we had PDD. So PDD is also been increased. That is the loss. So we are going to write it on the debit side of revaluation account. That is 2 PDD. We are going to find the difference between the old PDD and the new PDD. The new PDD is more, that is 600 rupees, and old PDD is 500, and therefore the difference amount is rupees 100. That is the increase of PDD by rupees 100. So we are writing it on the debit side of the revaluation account. Next we had is the furniture. The furniture, when we had compared between the old value, that is the book value, and the adjustment value, we have identified that there is an increase in the furniture value. So therefore, furniture will appear on the credit side of revaluation account. That is, the adjustment value is 45,000 minus the book value 40,000. So 5,000 is the increase in the furniture. So we write it as buy furniture 5,000 on the credit side of revaluation account. Now here when we compare with, we need to find the balancing figure, which will be the profit or loss. Now when we find the total, if you can see here, the credit side is 21,000 and debit side is only 1,000 rupees. So the highest total is 21,000. That should be written on both the sides. So here debit side is lesser. So the balancing figure will be the profit on the revaluation account. That is 21,000 minus 1,000 will be 20,000 profit on revaluation, which will be written on the debit side as to profit transferred to Anita's capital account, that is 20,000. Now will be divided to all the three partners in the old profit sharing ratio. So Anita's capital will be 20,000 into 5 by 10, that is 10,000. Anita will get 10,000 as the share of profit. And Kavita's capital will be rupees 20,000 into 3 by 10. So Kavita will get 6,000 as her profit. And here for Sunita's capital account, it will be 20,000 into 2 by 10, and Sunita will get the profit from the revaluation, that is 4,000. So total 20,000 profit is distributed to all the three partners in their old profit sharing ratio. So this is the revaluation account, and we have got revaluation profit which will be transferred to the partner's capital account. So now we are going to prepare partner's capital account. Once the revaluation account is being prepared and we have derived at the revaluation profit. So now the partner's capital account, we have to first bring down the balance. So we have the debit side, all the three partners, Anita, Kavita and Sunita. And on the credit side also we have Anita, Kavita and Sunita. So first we need to bring down the capital which is given in the balance sheet, which will be treated as the opening balance of the partner's capital account, which will be brought down on the credit side of the partner's capital account as by balance brought down. That is 50,000 Anita's capital, 30,000 is Kavita's capital, and 20,000 is Sunita's capital. So the old capitals from the old balance sheet is brought down as the opening balance of the partner's capital account. Next, what we have to do is we have to bring down the general reserve. The general reserve of the partners, that has to be brought down, which is given in the balance sheet. So in the balance sheet, we have general reserve rupees 10,000, which should be distributed to all the three partners in their old profit sharing ratio, which will be recorded on the credit side as by general reserve, that is 10,000 into 5 by 3, 10,000 into 3. General reserve rupees 10,000 should be distributed to all the three partners in their old profit sharing ratio 5:3:2. So Anita will get 5,000 general reserve, and then Kavita will get her share from the general reserve rupees 3,000, and Sunita will get 2,000 her share of general reserve from the firm. Now, once the general reserve is being brought down, next we have to bring down the revaluation profit, what we had calculated in the previous account. So it is revaluation profit. So we have to bring it from the revaluation account on the credit side as by revaluation account, and it is the profit. So 10,000 for the first partner Anita, 6,000 for Kavita and 4,000 for Sunita. This is the amount which we are bringing down from the revaluation account. Now once we had brought down the revaluation account, next is the goodwill treatment. Now the goodwill is given in the firm and we have to value it as per AS 26 given here on retirement of a partner. So as we had already calculated, the goodwill of Anita is 40,000 into 5 by 10, which will be 20,000. That is Anita's goodwill, which will be borne by the continuing partners, that is Kavita and Sunita, in their gain ratio. So therefore here Anita's goodwill, which is being taken by Kavita, will be on the credit side by Kavita's capital account 12,000 under Anita's column, as it is Anita's goodwill which is borne by Kavita, and then that is the goodwill amount which is to be borne by the partners. And next is Sunita is going to bear the goodwill of Anita, which will be also written it on the credit side as by Sunita's capital. That is the Anita's goodwill, which is borne by Sunita 8,000, which will be recorded under Anita's column. So this is the goodwill which has been recorded on the credit side. Since Anita goodwill is borne by Kavita and Sunita, we have to deduct it from their capital account. So here we are going to write it on the credit side as Anita's capital account on the debit side. That is the goodwill which is to be given to Anita by Kavita rupees 12,000 and by Sunita rupees 8,000. So which is borne by Kavita and Sunita should be deducted from Kavita and Sunita's capital account. So they are going to give the goodwill for Kavita and Sunita for the gain in the profit. So this is the goodwill treatment as per AS 26. Now once this has been done, now we have to balance the account. As I have already mentioned, on retirement, first we have to balance the retiring partner's account. So who is retiring here? It is Anita. So Anita's account should be first balanced. Now here we'll first take the total of Anita's column. The highest total is on the credit side, that is 85,000, which will be recorded on both the sides. 85,000. So out of this, according to the adjustment we have is that they have mentioned 35,000 rupees for Anita should be kept as a loan account. It should be kept as a loan account. So therefore we are going to write it as Anita's loan account 35,000. They have mentioned out of the total amount that has to be settled out of 85,000, 35,000 rupees should be kept as loan account, and the balance amount, that is the balance amount will be now 85,000 minus 35,000, that is 50,000 rupees will be paid through bank. So we are going to write we are going to write Anita's account and settle her account by paying through bank, that is to bank account, that is the balancing amount 50,000 is paid to her. So her account is settled partly by loan and partly by bank account. Okay, so this is the balance of Anita's account. Now we are going to balance the remaining partners account. So now Kavita's total will be 39,000. Again, credit side is higher. So write the same total on both the sides. Now once you have written, so find the balancing figure by deducting 39,000 with 12,000 on the debit side. So the balance of Kavita will be 27,000, and for Sunita again the total will be 26,000, that is credit side is more, which will be written on both the sides. So to find the balance we are going to deduct this 26,000 with the debit side total 8,000. So what will be the balance here for the partners? So we are going to write it here on the debit side, as debit side is lesser, as two balance carried down, 27,000 for Kavita and 18,000 for Sunita. So how did we get this 27,000? That is 39,000 minus 12,000, we get 27,000, and for Kavita, and for Sunita 26,000 minus 8,000, we get 18,000 as the balance for Sunita. So this is the balance which is considered as the new capital. So this will be the new capital which we are going to bring it down for the next financial year. That will be brought down on the credit side as buy balance brought down. For Anita, there is no balance as she has retired, and for Kavita, it is 27,000, and for Sunita, it is 18,000. This amount will be transferred to the balance sheet as the new capital of the new firm. So, this is the capital account. So we are going to see a note on the amount that has to be settled to the retiring partner. And since there is an adjustment given to us how the retiring partner has to be settled, he has to be settled partly by loan account and the other part is to be settled through the bank account. So here the note on the amount that has to be settled. So the total amount according to the capital account, so the amount due to Anita as per the capital account balance is 85,000. So this we got this by adding all the credit side totals, that is 50,000 plus 5,000 plus 10,000 plus 12,000 plus 8,000. So the total amount that has to be settled to Anita is 85,000. As per the adjustment, out of this 85,000, 35,000 should be transferred to Anita's loan account. So we are going to less that amount, less amount transferred to Anita's loan account, 35,000. So what is the remaining amount that has to be settled? That is 50,000. That is the amount that has to be paid through bank to Anita, 50,000. But as per the bank balance, what we have in the firm, in the balance sheet, if you see, the bank balance given in the balance sheet as on 31st April 2025, we are going to use it to pay the amount to Anita 8,500. But here the amount is not sufficient for us to settle her account through bank. Amount to be settled through bank is 50,000, but we have in bank account only 8,500. So the balance amount is 41,500. Since we do not have the sufficient balance, we are going to take a bank overdraft. So bank overdraft is obtained from bank, that is 41,500 to pay the retiring partner through bank account. So this is how the amount has to be settled to the retiring partner. So this difference amount 41,500 should be entered on the liability side of the balance sheet as it is the overdraft, a liability for the firm. So we will write it on the liability side of the balance sheet. So now let us prepare the balance sheet after the partner's capital account. Now here, first we'll complete all the entries on the asset side. So as per the old balance sheet given to us, we will go in that same order. So first we have debtors, but as per the debtors, we have a new PDD. So we are going to record it on the asset side with the new PDD adjustment. So debtors 6,000 less the new PDD 600, which will be 5,400 on the asset side. After debtors, we have the stock. That is, the stock also has decrease in the value of stock which is given in the adjustment. So we are going to adjust it on the asset side. Stock 9,000 less decrease in the stock, that is 900, which will be 8,100 on the asset side of the balance sheet. Next we have is the furniture. So furniture, we have the increase, that is the revalued amount. We are going to write that on the asset side directly. Furniture, that is 40,000 plus 5,000, that is the increased value 45,000 which is given in the balance sheet. Next we are going to take is the premises. So premises, we have again appreciation of premises which has to be added. So we are going to write it here on the asset side. Premises 80,000, add the appreciation of the premises 16,000. Total amount will be 96,000 on the asset side of the balance sheet. So these are the assets given as per the old balance sheet, which we have recorded along with the adjustments. Now, moving on to the liabilities. Now, the liabilities again, we're going to bring it down as per the old balance sheet. First, we have is the sundry creditors. There is no adjustment. So, we are going to write it as it is sundry creditors, rupees 15,000 on the liabilities side. Next adjustment we have is the bills payable. Again, for bills payable, there is no other adjustment. So we are going to write it as it is. Bills payable 12,000 on the liabilities side. Next we have is the provision for legal damages. So legal damages also again here there is no adjustment given to us. So we are going to just write it as it is. So provision for legal damages is rupees 6,000 on the liabilities side. Now, once we have recorded all these assets and the liabilities, now we are going to write down how the retiring partner is settled and what is the new capital of the continuing partners. Now, as per the adjustment, if we see that the retiring partner Anita is to be settled partly as loan and partly in the bank. So the amount that is kept as loan for Anita is a liability for the firm. So we are going to record it on the liability side. Anita's loan account, which is given in the adjustment, 35,000. So that is 35,000. So next what we have done is as per the partner's capital account, when we had balanced the retiring partner's capital, we are paying her through bank. Now, for this, kindly note the adjustment. Now, as per the payment through the bank, there is no sufficient funds in the business. So, we are going to pay it through the bank overdraft, and that is the calculation which we have already seen. So, it is bank overdraft 50,000 minus the amount of cash we have at bank is 8,500. So since there is no sufficient amount in the business in the bank account, so we are going to pay him or pay Anita, pay her through the bank overdraft, that is 41,500. So actual balance amount that is to be paid through bank is 50,000, but we have some amount in the bank account that is 8,500. Do you have to take that amount, deduct it from 50,000? So the remaining amount, since there is no sufficient funds, we are paying it through bank overdraft. That is 41,500 for the retiring partner. Now we have to record the capitals of the continuing partners. So that is the capital of Kavita and Sunita, which we are going to record it on the liability side. That is new capital, which we had got the balance from the capital account. Kavita is 27,000 and Sunita is 18,000. So the total new capital is 45,000. So this is how the balance sheet is being prepared with the settlement of the retiring partner. Therefore, the total of the balance sheet will be 1,54,500. So on both the sides, we get the same total, 1,54,500. So this is the total of the balance sheet. And so these are the entries that has to be recorded in the balance sheet of the firm on retirement of a partner. Hope this is clear, students. So this is a different adjustment for settling the retiring partner's account, partly in loan and partly through bank. Thank you. We'll see different adjustments in the next video.